In this video, we'll be going over different tax forms that you may need when you sit down to complete Schedule A while filing your income tax return. So, as a refresher, the IRS allows each taxpayer to claim either itemized deductions to lower their taxable income, or they can claim the standard deduction, which is a set dollar amount established each year by the Internal Revenue Service based on a taxpayer's filing status, age, and blindness, actually. So you're able to choose from year to year whether or not you want to itemize deductions based on different things like taxes that you paid, medical expenses, charitable contributions, so on and so forth. If you choose to itemize your deductions, then you'll complete Schedule A, and there are some tax forms that you may need either to complete or you may need to receive these tax forms to report the information properly to the Internal Revenue Service. So we're going to walk through Schedule A, and step by step we're going to go over the type of deduction, the tax form that you may need, and the circumstances in which you may need it. Let's go ahead and start with IRS Form 8962. This is the tax form that helps determine the premium tax credit. Now, the IRS doesn't really give a whole lot of guidance on this in the form instruction. It simply states that if you claimed an advance payment of the premium tax credit, or if you think that you're eligible for the premium tax credit, then you're supposed to complete IRS Form 8962 prior to starting the first line of Schedule A. The next form is IRS Form 1099-S, which is a proceeds from real estate transactions. So if you sell a home during the tax year, you are able in most circumstances to exclude capital gains tax from the sale of a primary residence if you meet certain ownership and use requirements. Generally, if you've owned and lived in your home for 2 out of the prior 5 years, then Internal Revenue Code Section 121 allows you to exclude either up to $250,000 for single taxpayers or $500,000 for married filing jointly. However, you are also able to claim as an itemized deduction taxes that you may have paid. So this would be under the real estate taxes. So let's go back to this form and let's just walk through. Let's imagine that in 2023, at the very beginning of the year, you paid $10,000 in taxes. So in this case, you closed on 6/30/2023. So you own the home for half the year and the new buyer owned the home for half the year. And as part of this transaction, the buyer paid for $5,000 of that real estate tax, which means that you cannot claim the full $10,000 deduction. So if you didn't claim a deduction, then you would simply take the $10,000 that you paid, you adjust that by $5,000, and then you're able to put $5,000 in here under the local, state and local real estate taxes. If you previously claimed the tax credit on taxes that you paid, let's say that it's not a calendar year, but you paid for an assessment that began the year prior. So you claimed a tax credit and then you end up selling the home. You may need to report that as other income on Schedule 1 of your tax return. So anytime you claim a credit for taxes that you paid or an expense that you paid, if you get reimbursed, the IRS usually will expect you to claim that credit or that deduction as taxable income. Let's go down to interest that you paid. So IRS Form 1098 is the mortgage interest statement. And so a lot of the information that you would be reporting to the IRS, such as interest, mortgage insurance premiums, points. All of that is going to come from your Form 1098. So you definitely need to have that if you're going to be claiming mortgage interest as an expense on your tax return. But what's this other form, 8396? This is for certain taxpayers that may have qualified for what's known as a mortgage interest credit or a mortgage credit certificate. So certain states and local municipalities can grant what's known as a mortgage credit certificate, which means they kind of subsidize your mortgage based on certain certain qualifications that vary from state to state. So if you've received a mortgage credit certificate, you must complete IRS Form 8396 prior. So if you get down to line 3 and you have any amount that you have included in here, basically as interest that you're receiving a credit for, then you can't turn around and claim a tax deduction on that same interest. And the IRS will expect you to complete IRS Form 8396 and then reduce the amount of interest that you're claiming a deduction on by the amount of interest that was provided as a credit. IRS Form 4952 is investment interest. So this is the form that allows you to calculate investment interest expense. So if you borrow money in order to invest money, then you can claim the interest expense as a tax deduction under certain circumstances. You may need to file IRS Form 4952. However, the IRS does say that this form is not required if you meet the following 3 conditions. First, if the investment interest expense is less than the investment income from your interest and ordinary dividends, which is your total dividends after you've subtracted your qualified dividends. If that expense is less than the income, if you have no other deductible investment expenses, and if you have no disallowed investment interest expense from the prior tax year. So if you don't have to report this, then if you meet all 3 of those category or criteria, then you don't need to file IRS Form 4952. If you make charitable contributions, there are a couple of forms you should at least be familiar with. The first is IRS Form 8283. This is non-cash charitable contributions. So for any non-cash charitable contribution, so basically anything that is not a check, money order, or some sort of transfer of actual currency, if you're donating clothing, furniture, things like that, if that deduction is more than $500, then you'll have to complete IRS Form 8283. And then there are additional criteria based on the dollar value of your donation. So, of course, these are all things that may have different treatments based on, how you, based on the value and the type of object they are, whether or not you need to have qualified appraisals, things of that nature. The other thing that you may need to know about is IRS Form 1098C. So if you donate like a car, motor vehicle, a boat, an airplane, then you should expect to receive a copy of Form 1098C from the qualified charity. And you probably will need to have this form at the ready, just in your records so that you know exactly how to complete your Schedule A. And if there's something that's inconsistent with what you believe your contribution to be, then you can settle that with the charitable organization as you're completing Schedule A. But you probably, if your donation is more than $500, you should be expecting this to come to you. Usually, usually by January of the tax year, although there may be certain deadlines. So the charity is supposed to furnish this form to you no later than 30 days after the date that they sold the vehicle, if box 4A is checked, or 30 days after the date of the contribution. So if none of those is checked, then you're going to need to have this tax form by the due date of your tax return for the year of the contribution. So and then casualty and theft losses, there are actually two tax forms, although one is a misprint. I'll enter the correct form number in just a second. So the first one is IRS Form 4684. That is the casualty and thefts form. You'll need to complete this just to make sure that your tax deduction counts. A few years back, there were some changes to the tax code, which really limited the amount of casualties or theft losses that a taxpayer can claim on their tax return. If it's a casualty, generally speaking, it has to be a named casualty, like a natural, like a disaster that would be declared by FEMA, a federally declared disaster. So you'll need to pay attention to that. Your casualty or theft may be reported on that. If you reported a loss, or if you're reporting a loss or a gain on certain property, you might also be completing IRS Form 4797, which is the sales of business property form, but it also involves involuntary conversions, and there are also different dispositions for these items. Specifically, line 18 right here, you would be entering any losses from income producing property that you're going to report on Schedule A. So you would need to, and then you would mark that as Form 4797, line 18A, and you would put that in the line on your tax return. So those are the tax forms you may need. And again, we've broken them down based on the category of itemized deductions that you might be interested in. So we'll put links in the show notes to all of the different articles and videos that we've created, not just for Schedule A, but also for each of these tax forms. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. If you have any questions, comments, or if there's another topic that you'd like to see discussed in an upcoming video, please hit me up in the comments section. Thank you very much, and have a great day.